You're welcome back. Now, let's look at another question. It says that J and B granted 200 options on its one currency unit ordinary shares to each of its 800 employees on 1st January 2001. Each grant is conditional upon the employee being employed by J and B until 31st December 2003. J and B estimated at 1st January 2001 that the fair value of each option was 4 currency units before adjustment for the possibility of forfeiture. And 2, approximately 50 employees would leave during 2001, 40 during 2002, and 30 during 2003, thereby forfeiting their right to receive the options. The departures were expected to be evenly spread within each year. The exercise price of the options was 1.5 currency units, and the market value of J and B shares on 1st January 2001 was 3 currency units. In the event, only 40 employees left during 2001, and the estimate of total departure was revised down to 95 at 31st December 2001, and 20 during 2002, and the estimate of total departure was revised to 70 at 31st December 2002, and none during 2003, spread evenly during each year required. The directors of J and B have asked you to illustrate how the scheme is accounted for under IFRS 2 share-based payment. To show the double entries for the charged profit or loss for employee service over the 3 years and for the share issue, assuming all employees entitled to benefit from the scheme exercised their rights and the shares were issued on 31st December 2003, and B, explain how your solution would differ as J and B offered its employees cash based on the share value rather than share options. Okay, they're saying that you should explain the scenario for a cash settled share based payment. Okay, this question is no different from the other ones we have solved, but it has more details. You just need to know what information you need and the ones you do not need. Okay, let's solve the question. Let's start from the end of 2001, which is 31st December 2001. So we need to estimate the value of the share option that will eventually vest. Let's look at the estimates we were given in the question. Firstly, J and B made an estimate at 1st January 2001. There, he gave us estimate of the fair value, which is 4 currency units, okay, which is the fair value of the option. And they also gave us estimates of employees that would leave, okay. Now, however, we are now told that in the event, like what actually happened is that at the end of 2001, 40 employees actually left, okay. So because of that, they now estimated, okay, they made an estimate, like a new estimate at the end of that period, which is what is relevant to us here, that the total departure, okay, should be revised down to 95 at 31st December 2001. So that is what is important. The estimate they made at the end of 2001. Therefore, the total number of employees that would leave over the 3 years period is estimated to be 95. So the value of the option at the end of 2001 will be the total number of employees that we have minus the total number of employees that will leave, so that we will have the total number of employees that will exercise their option. So 800 minus 95. They will multiply these by the number of options per employee, which as given in the question is 200. Okay? We'll multiply it by the fair value of the option, which is 4 currency units. The total gives us 564,000. Okay? Having determined that, then we can get the remuneration expense for the year, which will be 564,000 all upon 3, and that will be 188,000. So with this 188,000, we will debit staff cost or remuneration expense with 188,000 and credit equity with 188,000. At 31st December 2002, we would estimate again the total value of option that we eventually vest. We're told in the question that at 31st December 2002, that 20 left. Okay? And because 20 left again, they now made a new estimate that the total departure will be 70 at 31st December 2002. What that means is that at the end of 2002, the total expected departure is now 70. Therefore, we can determine the value of the option at the end of that period. And that will be 800 minus 70. Okay? Multiply by the number of options per employee, which is 200. Multiply by the 4 currency units. That gives us 584,000. From here, we can determine the cumulative expense at the end of year 2, which will be 584,000 multiplied by 2, which is 2 years, all upon 3 years. That gives us 389,303. Okay? So the remuneration expense relating to this year will be the increase, which is 389,303 minus 188,000. And that gives us 201,303. Therefore, we will debit remuneration expense with 201,303 and we credit equity with 201,303 at the end of year 3, which is 31st December 2003. They told us that none left, okay, during 2003. Therefore, we can know the total number of employee that has not left because this is the year where it will vest. Okay, because based on the information we were given, we were told that 40 actually left in 2001, 20 left in 2002, and none left in 2003. So in 2003, there's no need for estimate because that's the actual. That is when it will vest, so we can know what has happened. Hence, the value of the option will be 800, which is the total number of employees, minus 40 that left in 2001, minus 20 that left in 2002. And the balance gives us the total number of employees remaining to enjoy their share option, multiplied by the number of options by employees, which is 200, multiplied by 4 currency units. It gives us 592,000. Therefore, the remuneration expense for the year 2003 will be 592,000 minus 389,333, which is the cumulative up to 2002. And it gives us 202,667. So with that, we will debit remuneration expense with 202,667 and we credit equity with 202,667. And that is how we are going to account for the share options in each year. Now, they also told us that we should account for the share issue. Okay? Now, to account for the share issue, we need to know the total number of share options that actually vest at the end of the 3rd year. Based on the information we were given, we know that 40 actually left in 2001, 20 in 2002, and none in 2003. So only 740 employees actually exercised their option. So 740 multiplied by the total number of employees gives us 148,000 options, right? And we're told in the question that the exercise price is 1.5. Okay? So the value of the share issue is 148,000 options multiplied by 1.5, and that will give us 222,000. Okay? Now, this 222,000 is the amount that will be paid by the employee to exercise their options. So we debit cash account with 222,000. Credit share capital with the nominal value, which is 148,000, multiplied by one currency unit, because that's the nominal value from the correction of this company. That gives us 148,000. And the share premium, 148,000 multiplied by 0.5, and that gives us 74,000. Okay. However, the equity reserves, cumulatively to date, we have credited a total of 592,000 to equity, okay, which is this. Now, we need to transfer that from the equity to, say, the share premium account, okay, because it has vested now. So we don't need to still be carrying that equity in the books. So we transfer it to share premium, okay. So we're going to debit equity reserves with 592,000 to remove it from our books, transfer it to share premium, 592,000. And that is how you account for that transaction. Now let's look at the B. The B is looking at if this transaction were to be a cash settled share-based payment, how would you have done it? Okay, that's what we are going to be looking at. From subsequent videos, we'll start looking at that. However, for this scenario, if J and B had offered cash payments based on the value of the shares at vesting date rather than options, okay, what we'll do is that the credit entry of the remuneration expense will be recognized as a liability, okay, rather than as equity. And the movement in the liability would be charged to P or L. You'll see that in action very soon. So thank you very much. See you in the next video.